Welcome to JS Online Tuitions, and today in account we'll be looking at books of original entry. So books of original entry, these are books in which we first record transactions. Books of original entry are also referred to as day books or journals. The common books of original entry are discussed as follows. So the first one we have sales day book. So the sales day book is also referred to as the sales journal, and the sales day book records credit sales. The second one we have the purchases day book. So the purchases day book is also referred to as the purchases journal, and this records credit purchases. Then we also have the sales returns day book. So the sales returns day book is also referred to as the returns inwards day book. It can also be referred to as the sales returns journal or returns inwards journal. And this day book records sales returns or returns inwards. The other day book that we have the purchases returns day book. It is also referred to as the return outwards day book. This day book is also referred to as the purchases returns journal or returns outwards journal. The purchases returns day book records purchases returns or returns outwards. The other day book that we have the cash book. So the cash book records receipts and payment of cash and check. Then we also have the general journal. So the general journal includes other items that are not recorded in the other day books. So these include items that are not recorded in these other day books that we have mentioned, and this includes the sales day book, the purchases day book, the sales returns day book, the purchases returns day book, and the cash book. We can now look at the ledger. So the ledger is the main book of accounts. There are three types of ledgers, namely sales ledger, purchases ledger, and the general ledger. A sales ledger, this is where we record customer personal accounts, whereas the purchases ledger, we record suppliers personal accounts. In the general ledger, entries that remain in double entry accounts are recorded, such as relating to expenses, non-current assets, and capital. Let us now look at the types of accounts. So there are two types of accounts, namely personal accounts and impersonal accounts. Impersonal accounts are further divided into real accounts and nominal accounts. These accounts are described as follows. So the first one I've said we have personal accounts, and the second one we have impersonal accounts. So we are going to start with personal accounts. So personal accounts, these are accounts which deals with business transaction carried out with person, firms, and the business. These types of accounts exist in the name of persons and firms. They include amount of credit, customers, and these are referred to as debtors, and credit suppliers, and these are referred to as creditors. Then the other type of account that I've said, we have impersonal accounts. So these are types of accounts that are not personal accounts. Impersonal accounts are made up of real accounts and nominal accounts. So we're going to start by discussing what real accounts are. So these are types of accounts in which possessions are recorded. These possessions are made up of assets of the business. Examples of real accounts are inventory, furniture, buildings, machinery, stock account, cash account, and motor vehicle account. Then let us talk about the nominal accounts. So accounts in which expenses, income, and capital are recorded is referred to as the nominal account. So we can remember that real accounts represent assets which are in use over many accounting periods. Then in this case we can say that the nominal accounts represent values that ceases at the close of each accounting period. New expenses and incomes of the same kind will arise again in the next accounting period, and then again become extinguished with the close of the respective accounting period. Expenses are cost of running the business during the accounting period. Examples of expenses include purchases, salaries, insurance, electricity, and wages. Income or revenue is money that is earned in the business. Examples of income include sales, rate received, interest received, and discount received. So we can look at this diagram, and this diagram represents accounts. And I said that there are two types of accounts. We have personal accounts and the personal accounts. And we have further said that personal accounts are divided into real accounts and nominal accounts. So that is a simple diagram that you have to know. Then let us look at terms used in financial accounting. So the first one, we have sales. Sales, these are goods that are bought by the business for resale with an aim of making profit. Sales can also be defined as the money received by the business from goods that had been previously bought for the purpose of resale. Some goods are not recorded as sales because they can be sold, but they are not bought to make profit. For example, selling and disposing of an old asset is not treated as sales, and such a transaction should not be entered in the sales account. So for example, if a company had bought some fixtures and fittings for 10,000 kwacha and it decides to dispose it off by selling off the fixtures and fittings at 7,000 kwacha, that amount won't be recorded in sales because the fixtures and fittings were not bought for resale. But in a case whereby a company that orders the same fixtures and fittings for resale for the purpose of making profit, when it sells that item, that means that we can record it as sales, since those items are being bought for resale and with an intention of making profit. So that's sales. Let us now look at purchases. So purchases are goods that are bought by the business for resale with an aim of making profit. Purchases can also be defined as amount of money spent on buying goods intended for resale in order to make profit. Any other purchases that are not intended for resale, for example, purchases of fixed assets such as land, is not treated as purchases, and such entries are not entered in the purchases accounts. So let us now look at income or revenues. So this is the amount of money received by the business from different sources, the main source coming from the sale of goods and provision of service to its customers. The other sources include commission, rent, which is income received for renting out buildings and premises. Then we have interest received on bank deposits, dividend received on shares held in other businesses or companies. So let us now look at expenses. So this is the money used when running a business. Expenses include wages and salaries, rent, electricity, and water bills. Then we also have selling and distribution expenses. We also have transport. Let us now look at creditors. So creditors are people whom we owe money. A creditor can either be an individual or group of individuals to whom money is owed for goods bought from them on credit, or for money borrowed from them for use in the business. Money owed to creditors in accounting is taken as a current liability. Then let us look at debtors. So debtors are people that owe us money. A debtor can either be an individual or group of individuals that owes money to the business for goods and services bought from the business on credit. Money owed by the debtor to the business is taken as a current asset in accounting. Let us now look at capital. So capital is the amount of money or resources invested in the business by the business owner or entrepreneurs. Let us now look at assets. Assets are anything of value owned by the business or an individual. The term assets in accounting means properties owned by the business that help in generating income or facilitate business operation. Examples of assets include land, buildings, machinery, cash at bank, cash at hand, stock of goods or raw materials. The term assets in accounting is only restricted to properties or resources and not human beings. Assets are divided into fixed assets and current assets. Let us now look at liabilities. So these are financial obligations that have to be repaid by the business to the creditor. Liabilities arise out of borrowing money from financial institutions or individual lenders to finance business activities and purchasing goods and services on credit. Liabilities are divided into long-term liabilities and current liabilities. Examples of liabilities include creditors, bank overdraft, debentures, and long-term bank loans. Let us now look at the importance of books of original entry. So the first importance, we have avoid overcrowding of the ledger. Then we have reduces possibilities of fraud. Then the other importance, we have improves efficiency. The other importance, we have future reference points. Then the last importance, we have reduces the risk of omission of one or both entries. Let us now look at the cash book. As we know that cash and bank transactions are types of business transaction. Most businesses in Zambia carry out cash transaction that includes cash payments and receipt. In bank transaction, which includes check received, money received by check, and check payment, money paid by the business using check. These business transactions are recorded in the cash book. A cash book is a book of original entry where cash and check receipts and payments are recorded in order of dates. And that means that these are recorded in chronological order. Credit transactions are not recorded in the cash book, but payments made to creditors by the business and money received from the debtors by the business is recorded in the cash book. The cash book has two sides: a debit side where cash received is recorded and the credit side where cash payment is recorded. Cash that is recorded in the cash book means bank notes, coins, money orders, credit transfer, check, or any other monetary payment or receipt acceptable in settlement or business debt. A cash book is said to be a book of original entry and a ledger. So it is said to be a book of original entry because any receipt or payment of cash is first recorded in the book before being posted to another ledger account. This is why there is no subsidiary book for cash transaction other than the cash book. Then the cash book is the ledger account because for every debit or credit entry made in it, there must be a corresponding debit or credit entry in other accounts in the ledger. Further, once a record is made in the cash book, it is permanently kept there. There are 4 types of cash books, namely single column cash book or 1 column cash book or simple cash book. Then we have the 2 column cash book or double column cash book. Then we have 3 column cash book or triple column cash book. Then we have the petty cash book. So this program has been brought to you by Jos Wale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless.